Good afternoon, everyone. This is Sadia Zafar from HRAI. I would like to welcome you to today's session on HVACR Contracting Business 101. This is a part 2 of the ClimateCare series. Our presenter, Glenn Mellors from ClimateCare, will discuss key points that will inspire you to keep thinking of ways to improve your critical business performance. In terms of housekeeping, I would like you to know that on your control panel of your screen, there's a Q&A feature. Please use that Q&A feature to ask your questions at any time during the webinar. They will be addressed at the end of the session. Also note, this webinar is being recorded and the recording will be shared with you following the session. Now we welcome Glenn.
Good afternoon, everyone, or good morning or good evening, depending on where you're located across this fine country of ours. Welcome to session number 2, Business 101 session number 2. This session is going to be really focusing on the 15 things that you should know to help you sleep better when owning a contracting business. I'd like you to take a pad of paper and a pen and maybe have a calculator, maybe even your financials beside you, and take some notes while we're going through this. Please don't hesitate to ask questions at the end. Be more than happy to go through it. Nice to see some of the faces out there. Ron Wright, always appreciate you showing up. Riddell's Contracting, Buttons Contracting, Bosnack's, Santa Baxter, without sounding like romper room here. It's just nice to see those faces from the past. Steve Tomlinson, I see you're out there as well. So some of you were on session number 1 and you got to meet me then. I've been in the industry for over 43 years now. I'm an educator at heart. I love to learn from people like yourselves. My role is to visit contractors like yourselves, to learn from you, to learn what works, what doesn't work, the good, the bad, and the ugly, and then to gather that detail and to be able to put it in presentations such as this to share with you so that you're not alone out there wondering, are you doing well? Is there things I could be focused on? What are some of the things that I could be focused on? And so we're going to go through some of that stuff today. So as you recall, for those that were on session 1, and I am going to do a little bit of a review of session 1, ClimateCare's goal is helping contractors make more money, have more fun in this industry. It's stressful enough with everything that's going on around us with price increases and labor shortages. So we really do want to focus on having more fun and be less stressful. And then, of course, prepare our business for the highest possible rewards upon our exit. So, and as you may recall, my belief of what we do in our industry is that we do not sell furnaces and air conditioners. It's not about fixing equipment when it fails or doing a maintenance on a functional piece of equipment. What we really need to focus on, what we need to do is sell customer experience. People are going to remember you either in a good way or a bad way, much like, as I mentioned before, or maybe new to you. If you recall your childhood days, you can remember your best teacher and you can remember your worst teacher. So which one do you want to be in the customer's eyes moving forward? If we're not the ones that they feel are the best, then we're simply competing on price. And, it may be time that we really look in the mirror and see what we can improve with our customer experience to deliver, a great, memorable experience so that next time they want our products or services, or they hear somebody that does, they're going to recommend us. So that's going to separate us from the pack. Today, we're going to be talking about the 15 critical performance measures. And, my success to these sessions, which I enjoy doing, but I'm not successful unless you walk away with a couple of aha moments. My goal for today, I refer to it as a pearl. So I'd like you to pick your pearl out of this session. Take away something that you're going to implement or a strategy you're going to discuss with your teammates to help improve the quality of your business from a performance level. Today's agenda, we're going to be focusing on beginning with the end in mind. We're going to think about where we want to be, and we're going to establish some timelines around where we want to be. We also need to discover where we are today. Many of us are floundering. We go into work every day, and I say, there's 2 ways to manage our businesses. You can go in the morning and the phone rings and the guys and gals start running around and you're going to deal with crap happens. Or the other way to do it is you can manage your company and create a predictable day for everyone. Predictable days mean a lot less stress. We're going to talk about establishing a roadmap and then understanding your limitations. If you're shooting for the stars and you don't have the horsepower to get there, then maybe we need to be looking at what are our limitations, what can we overcome, what is outside of our boundaries, and where is our maximum performance level at. And then, of course, we'll follow up with a Q&A session near the end. So last session was talking about beginning with the end in mind, and I'd like to do a bit of a review with you. So it's going to be quick. I will have a lot of information that you have shared with me over the last 40 years that I want to impart to you. And of course, I'm going to continue to learn from you in the Q&A portion of the session. So quick review of the begin with the end in mind. Number one, business strategy was, when do you start preparing your business for your exit strategy? And my short answer to that is today. It takes approximately 3 to 5 years to prepare a business for sale. It takes a lifetime of the business to put you in a position that you were seeking when you first set out and first opened your doors. Remember, another business strategy is a business is simply a tool to make money. We need to remember that. We can get emotionally attached to it, but we have to remember it is a tool to make money. Being a tool, it needs to be oiled, greased, cleaned, repaired, replaced in some cases, certain parts of it. So we need to be thinking about that as we move along. And we're going to be talking today about how that tool can make money by simply oiling it. Remember, wealth does not come from the business itself, but rather what you can do with that money that creates the wealth, whether it's investment, real estate, vacation properties, but it's really going to be how you invest that money that the tool of the business makes for you. So a couple of guiding principles. We're going to just review cash spread, cash on hand and overheads, revenue growth, performance measures, which is really our focus today, critical performance measures, daily report cards, and taking care of your health. Without a healthy owner, the business health suffers as well. So cash on hand, as a quick review, it's our cash on hand plus accounts receivable minus our operating monies equals cash spread. So we look at our monthly operating expenses and we take that away from our cash on hand and our accounts receivable. Good, clean accounts receivable, that means less than 60 days old. You need to be looking at it every day and then figure out how many months you have that are set aside. In order to be the company that builds strong relationships with its suppliers and vendors, that company needs to pay, your company needs to pay those suppliers on time. So without that cash spread and without months of money set aside, you're going to be in a situation where you're not going to be able to keep up. We talked about overhead quickly. Overhead equaling our break-even point. We take our overheads, all the expenses, the fixed expenses that you'd have in the course of a month. And then we look at our gross margin profit run rate. And in this example, we're going to talk about 40% gross margin run rate. If our overheads are 42% or $42,000, we're going to divide that $42,000 by 40%. It's going to equal $105,000. So our revenue break-even target is $105,000. So I strongly advise you to build a budget that has your break-even numbers covered, and then look at building the same budget with a EBIT profit calculation built in, approximately 10 to 20%. The last thing I want to cover here before we move on is the efficiency rate. This is what kills companies, not understanding efficiency rates. So it's a measurement to determine the amount of time you can actually generate revenue versus the available time to produce revenue, or what you're spending. So as an example, if there's 365 days in the year, in a calendar year, but you're only open Monday to Friday for for 52 weeks, that would give you 52 times 5, which equals 260 days. So our effective efficiency rate would be 260 divided by 365 equals 75 or 71% efficiency rate. So we're not 100%. We need to build our budgets accordingly. We need to look at the revenue being divided by 71% to get an effective daily run rate. And of course, the last thing here is there's no such thing as 1.5 day jobs. In my mind, they're either 1 day or they're 2 days. If they're a half a day job, you got to have the gross margin required dollars for the day built into that half a day. It's not $400 worth of labor. It might be $400 plus $1,000 in gross margin contribution dollars when you price such a thing out as a 1.5 day job. So just remember my golden rule, there's no such thing as a 1.5 day job. We're going to start talking about performance measures. And my question to you would be, do you have performance metrics in place? If you're involved in Service Titan as an example, there's other Service Workbench, those types of computer program software that runs and drives your business. They have approximately 80 metrics in place. Now, obviously, it's impossible to keep on top of 80 metrics every day or week or month, but I guess my question is, at the end of the year, are those metrics being met? You need to adjust where necessary, and we're going to talk about that in this session. So let's get into the meat and potatoes here, performance measures, the 15 things that you should know off by heart so that you can go to sleep at night and have a restful sleep, or at least have good direction as to where you're going to work on your business when you go in the morning. So critical performance measures, known by some as KPIs, key performance indicators, they're the 15 guiding principles that when measured, you can tell exactly where you should be focusing your time. All too often when I get into coaching sessions with clients, they don't know where to work on their business, and they end up working on areas of the business that they're comfortable with rather than the areas of business that need their attention and they're less comfortable with. I call it the low-hanging fruit. You know, if anyone's studied with Ron Coleman over the years, or any business coach for that matter, they'll talk about the 2% rule. If you could tweak areas of your business by 2%, 2%, 2% in different areas, the net outcome can be as high as 10 or 15%. That's really what we're going to talk about now. So the key performance measures, they take a snapshot at a time and pinpoint where you are. So it's like closing your business for 1 minute and really having a good look at that picture of where you are today. And it's going to give you the fundamentals that are going to lead you to success with your business, with whether it be growth in revenue, whether it be profitability, whether it be efficiencies. These are the things that are going to come out of the critical performance measures, and they're going to have a major impact on the profitability of your company. Before we get started, I always talk about what is the heart of the business today. It's evolved, it's changed over the last 20 years. You know, we used to rely on newspaper and yellow pages and break fix situations where the furnace is broken and it's, you know, light up season, or air conditioner is broken and it's light up season for the air conditioner to drive our business. Obviously, we're a 12-month, 260-day year business or more, depending on your service hours. So we need to have some stability within our company. So I call the heart of the business planned maintenance agreements. It's what's going to drive your reoccurring monthly revenue. Imagine this: if you had 5,000 planned maintenance agreements, each paying you $10 a month. How would you like to have $50,000 coming in without even turning the lights on every month? You know, we talk about how we're going to fund those early season buys or take advantage of promotional clearances at our local warehouses. And where do we get that money from? If you had the steady reoccurring monthly revenue, you could draw from that account, that money that's been set aside to deliver those planned maintenances, borrow from it, if you will, and take advantage of those. Adding another 4 to 10%, maybe even as high as 15% gross margin dollars when you complete an install. So if we can get 1,200 planned maintenance agreements feeding the heart will then turn that into replacement sales, demand service, indoor air quality, and other add-on sales. 1,200 planned maintenance agreements will ensure that you have $1 million in repeatable revenue. Wouldn't that be nice to go in on January the 1st, knowing that you're going to be building from, depending on how many maintenance plans, if I have 4,800 maintenance plan customers, I could be building on a $4 million customer without doing any marketing whatsoever. Very, very nice way to start your year. We're going to talk a little bit more about that, maybe not so much in this session, but definitely in the next session. But what I really wanted to do is give us a focus of where we're starting from. Where does our business development start from? What do we need to work on to deliver to our company 1,200 maintenance plans, maintenance agreements, and deliver $1 million worth of revenue from those agreements every year? So we need to put some measurements in place to know that we're on track. So this is what you've been waiting for. This is what you want to hear about today. It's what's the meat and potatoes of what am I going to measure? What are the 15 things that I should know off by heart if I was to meet a fellow business owner on the street and we were discussing how our businesses are doing? We talk about, oh, we're busy. You know, we're not busy. Oh, things are good or things are poor. How about really talking about things that count? Like, what's your revenue per employee? What percentage of your sales leads come from your demand service? What percentage of sales leads come from your planned maintenance agreement customers? Or what's the percentage of planned maintenances sold per demand service visit? What's your current average ticket price on a demand service visit? What's your current average ticket price on install sales? How are your sales folks doing? What's their closing rate on sales opportunities? Not just appointments met, but also from a person coming to the door, whether it be phone, email, internet, knocking on your door, meeting you in the grocery store and saying, hey, I'm interested in your products or services. What's the closing rate and conversion rate on those opportunities? What about your cost of doing business? Talking to someone about what's your labor as a percentage of revenue when it comes to demand service call? What's your percentage of revenue, labor as a percentage of revenue for planned maintenances? How about your installs? How much labor do you truly have in an install? If you recall last session, we talked about efficiencies and knowing what our true labor cost was. Well, how does that equate into our installation? How do we know we're pricing jobs correctly? What is the gross margin dollars being delivered as a percentage of revenue on your demand service department? Demand service has very high overheads, demands very high gross profit margins. Planned maintenance department is really our marketing department. Are we looking for significant profits on the planned maintenance department? Maybe, or maybe not. I'll tell you a little secret. If you're going to get into the planned maintenance agreement business to make money off of planned maintenance agreements, turn your head and walk away. You're not going to make business or money off of planned maintenance business alone. It is your marketing tool. It's getting paid to go into someone's home to sell them something that they could use and benefit from. And then our gross margin is a percentage of revenue when it comes to installations. Each of those three have separate key performance indicators or critical measurements. We need to understand those and learn from that. And if we know what our gross margin percentage of revenue is, and we know what our labor as a percentage of revenue is, the byproduct of that equation gives us our material as a percentage of revenue, something that's also very good to know. Last but most importantly, the final two things: phone call to appointment conversion rate and revenue per maintenance customer. We're not here to just make friends. We're here to make sure that we're feeding our business with the money it needs to survive. So the first thing we need to do in order to gather this information is create some sort of a tool that you can collect this information. And we have a tool internally at ClimateCare, but you may be able to create a tool based on this information, simple Excel spreadsheet, piece of paper and a ruler and a pencil, start building grid lines, get started, get collecting the information. Over a period of time, this information becomes invaluable. So the first thing that we need to understand is our revenue per employee. How we calculate that is quite simple. We take our rolling 12 revenue and divide it by the number of people on payroll at that particular moment in time. Our textbook target for revenue per employee for a residential replacement, service, and maintenance business is $200,000 per employee. Why do we need to know this? We need to understand if we're overstaffed. If we're overstaffed, it's going to indicate, that's going to be indicated by a low revenue per employee ticket. It could be down as low as 130, 140. Well, if that's the situation, I'm going to want to monitor that for 1, 2, or 3 weeks, and then make decision to reduce staffing based on that requirement. However, if my revenue per employee exceeds $200,000 by 5, 10, 15, 20, as high as 50, I've seen it as high as 100,000 higher, then you're looking at possible burnout. You're looking at more callbacks based on rushing through what they're doing. And you're also opening yourself up for more opportunity for injury on the job site. Number 2, service calls to install leads. We're going to take the number of leads that's generated by the service department and divide that number by the number of service visits. We're looking at targeting 20% of our service calls should create an install lead. It could be a furnace or AC, could be a water heater, water softener, could be indoor air quality products. It's going to create something. If you read any of the studies that have been done by the likes of Todd Lillies or Rodney Coop, they're going to tell you there's an average of $1,500 to $3,000 of installation opportunity after a comfort advisor leaves the home that they never quoted on. So we want to target that. And again, when we talk about predictable business, if we know we have 100 sales or service calls for next week, we can start to budget that 20% of those, or whatever that number is as you're measuring, is going to turn into an install. That helps us with labor control for the following week. Critical performance number 3 is planned maintenance calls to install leads. Now we're out doing planned maintenance. We do the same as before. We're going to divide the number of leads provided by the planned maintenance agreement visit by the number of planned maintenance visits. So this is going to give us a target of over 10%. This is what we're looking for. So our planned maintenance agreement should be driving over 10% opportunities. Okay. And now what you can do if you understand this and you understand demand service, you understand your planned maintenance, and you understand your installs, you can start to schedule your planned maintenance agreements based on equipment age, depending on what you need to fill the hopper for the work following in the next few weeks. If my installs are down, I'm going to schedule planned maintenance agreements on equipment over 10 years of age. If my install department's full, I'm going to start scheduling planned maintenance agreements for equipment 5 to 10 years of age because I'm looking for demand service work. And if my install department is full, my service department is full, I'm going to focus on planned maintenance agreements on equipment less than 1 year or less than 5 years of age. So that's really just a re-education, add-on sale opportunities, not really looking for demand service work, and we're not looking for install work. So that's how you can use that to start to control your business and create more predictable business weeks. You know, a company should be able to dictate the outcome of their month by the 10th business day of every month. They should be able to predict their year end by the end of the 7th month of every year, not waiting till the month is closed. Month is closed, we're now looking at history. If we're looking at our critical performance measurements every week, we're now massaging our business activities to ensure that we hit our targets. So service calls to plan maintenance agreements. Again, we take our number of service visits and we take the number of planned maintenance agreements sold and we divide it by the number of service visits. We're targeting at least 25% of our demand service turning into planned maintenance agreement. We're looking at during the daytime, Monday to Friday, probably 10 to 15% of the demand service calls have a planned maintenance agreement opportunity. And if it's after hours or weekends, we're looking at 85 to 90% of those turning into planned maintenance agreements based on the savings alone that can be generated for after hours work. Number 5, average ticket price of a service visit. We divide the service revenue by the number of demand service visits, and our target is over $350. Now, this sounds silly, and you know it should be an easy target to achieve. However, I have been to so many companies where I ask the owner, "What is your diagnostic fee?" Well, it's $100. Okay, $100. And then with HST, we're looking at $113. Ask your system to pull out a list of invoices that were $113. And then ask your service department computer system, software system, to pull out invoices that are over $150. And it's shocking to see the number of diagnostic calls only. This is the way that you're going to regulate this. You're going to understand there is no such thing as a diagnostic only. A diagnostic only can only occur if it turns into a equipment replacement opportunity. Failing that, the piece of equipment was not working when you got there and was working when you left. What did you have to do and what did you charge for it? Simple education will go a long ways in increasing revenue opportunities by monitoring your average ticket price. Average ticket price of install. Take the install revenue divided by the number of installs. When I first start working with companies, it's not uncommon to find the revenue average ticket price around $4,500. And after the course of a couple of months, the target is moved up to $7,000 to $9,000 average ticket install price, and exceeds that, but we're talking average here. Motor bearing units, $7,000 for cash sales and $9,000 for finance sales. We know that there's at least a $2,000 upsell opportunity when you go to flexible monthly payments. So imagine now we know the number of service visits, we know the number of maintenance visits, we know the number of installs, we know the average ticket price. If we had that information, could we start to build a plan to know that we can meet or exceed our targets every month? Absolutely. Let's go into number 6. Or number 7, closing rate on booked appointments. Here we're going to take the number of installs divided by the number of booked appointments. And this is appointments that the office has booked for a salesperson, comfort advisor, technician to go out and sell something. Our target closing rate here is north of 60%. So 6 out of 10 visits should create a sale. If it's equipment sales, it should create a sale of $7,000 to $9,000. So now, if you know this information, whatever the numbers work out to, if we know we have 10 appointments this week for installs, we know we're going to close 60% of them, or whatever that number might be. And we know that we're going to have an average ticket price of $7,000 to $9,000, or whatever that number may really be. And now we've predicted what our business is going to look like next week. So we get off of worrying about tomorrow and we start thinking about 2, 3, 4 weeks down the road. Halfway through the month, 10 business days in, I already know where I'm going to finish in the course of the month. 8, 9, and 10, labor is a percentage of revenue. We simply divide the cost of labor by the revenue. So when we look at our targets here, target for demand service, 22%, target for planned maintenance, 35%, and target for installs between 9 and 11%. So a $100 service visit is a great way to check your pricing to see if you're on track or on target with your pricing. If it's a $100 service ticket, no more than $22 can be spent on labor. If we have a planned maintenance and it's a $100 planned maintenance, no more than $35 can be spent on the planned maintenance. Why do we allow for a higher planned maintenance labor to revenue? Because we want them to spend time talking to the customer, doing that planned maintenance in front of the customer, having the customer sitting on a chair, looking over my shoulder, gives me an opportunity to be able to discuss all the products and services that I have to offer. So when I'm preparing my invoice, is there anything that we talked about today that you would like to take advantage of? It is our marketing department when we're in the house. When it comes to installs, the install labor should not be more than 9 to 11% of our install. And so again, we can check our pricing. If we know what our cost of labor is, and we divide that by 10% right in the middle, we know what our selling price should be. And if those numbers get out of line, then we need to readjust our pricing to deliver the gross margin that we need to deliver. And speaking of which, the gross margin departments have targets too. To calculate gross margin percentages, it's net revenue minus direct expenses divided by net revenue times 100 equals our gross profit margin ratio. Our target for demand service is 65%. Now that sounds like a lot, but it's not. Demand service consumes the highest percentage of overhead of all of our departments. It can consume as much as 50 to 55%, even as high as 60% of our revenue in expense. So we need to deliver 65% to turn any form of profit out of our demand service department. I can't tell you the number of times that I've gone in to work with $5 million companies that are producing 2 to 5% EBIT and can't understand why when their sales are as high as they are. And by the time I break down demand service and install, and we divide those two up, we'll find out the demand service department lost $500,000 or $600,000, while the install department created $1 million in profit, 20%, and we end up making a company gross profit or EBIT of 5 to 10%. Planned maintenance is high again for gross margin dollars because we are spending a lot of time and there is a lot of administration work to planned maintenances. Imagine managing 4 to 5 to 6,000 or 10,000 planned maintenance agreement customers. Some of our largest companies and most successful companies throughout the HVACR have had upwards of 10,000 maintenance customers. The likes of Atlas, Haven Home, Anchor, those guys had 5,000 homes that they did maintenances on. Our target install gross margin is 52% pre-commissions. So depending on where your accountant places your commissions, it could be above the line or below the line, but I'm looking for a 52% gross margin regardless of where you apply it as a direct expense or as a below the line expense. And as a side note, to calculate the cost of material, we take the labor and the gross profit margin and we subtract it from 100. So when we look at our target for demand service, again, this is a litmus test to find out if your pricing is accurate. If the cost of part is greater than 13% of the total revenue generated, we need to raise our prices. If our cost of materials on a planned maintenance agreement exceeds 5% of our planned maintenance revenue, then we need to adjust our planned maintenance cost, selling price. And our target for install, if our materials and equipment exceed 48% of the selling price, we need to adjust our pricing. So now you have 3 distinct ways of checking your pricing and making sure that you are priced accordingly to produce a EBIT profit of 5 to 10%. Conversion rate of phone call to appointment. This is the least respected and highest return. And I don't mean to be making fun of anybody or anyone in particular, but how often do you hire a student to answer the phones? The person that's the last into the office gets saddled with the telephone. You know, it has one of the largest impacts of revenue growth that your company has is based on who is answering that telephone. We're looking at a combined conversion target of 85% of phone calls turning into a point of action. Each phone call costs a company between $50 and $100. And that means that's averaged out through the total number of calls, a spouse calling, a child calling the office, a supplier calling, customers calling. If we take that total number of phone calls, divided it by the average marketing spend for the course of the year, which includes things like sponsorships for kids' sports, building signage, truck signage, advertising, golf tournaments, all that type of thing. We combine that all into our marketing budget, divide it by the number of times the phone rings. We can anticipate that it's going to be somewhere between $50 and $100 that it costs our company. So what I'm looking for and what I'm asking you to think about is every time that phone rings, listen to how it's answered. Think that you just spent $50 to $100. Let's call it 75. You just threw $75 in the wastebasket. Now you listen to that call. If it turns into an appointment, you can reach over and pick that $75 out of the garbage pail, put it back in your pocket. But if it doesn't turn into an appointment, then you're going to leave that $75 in the wastebasket. And at the end of the day, a week or month, it'd be interesting to see how much money is in that basket. One of the largest increases in business has been had by increasing the conversion rate. And I'll tell you, I'll be quite frank with you. If I go into a company that has not had any customer service representative training, any telephone training, just an average company, we start out with about 40 to 50% conversion rate. And you're going to say, oh, that's horsebucky. And matter of fact, I've spoken to customer service representatives all across this province, matter of fact, probably all across Canada and into the US. And they'll start off by saying, you know, I probably convert 90% of the phone calls. And then I'll start asking questions. Do you ever get anybody that just asks about it? You know, how much is a service call? Well, yeah. I said, well, what happens when you tell them? Well, as soon as I tell them it's $100 just to send a guy out to the house, they say, I'm going to call around and I'll get back to you. Well, how many times would that happen? Oh, maybe 10, 15% of the time, depending on the time of year. In light up season, it might be as high as 20, 25%. Well, what about when someone's calling for a furnace or air conditioner? Oh yeah, they want a price over the telephone. Yeah, and how does that go for you? Well, typically I give them a price over the phone and they say they'll get back to me. Well, how many times does that happen? Well, that's probably light up season, 20% of the time. So now we've gone from 100% or 90% of those phone calls being converted into appointments down to 50%, would you say? Yeah, that would be about right, 50%. Well, imagine if I could train those CSRs to handle those phone calls and convert 85% of those into point of action. What would that do to the revenue of your company? You would now increase your opportunities by over 70%. And if over 70% of the opportunities arise, how much is your revenue going to increase? How much money did it cost you to get there? Maybe a little bit of training. Very important to understand. And again, I will tell you, this is an exercise well worth doing. If you want to collect the information, it can be done as simply as a pad of paper and a tick sheet. But what you are going to find is going to be very revealing. I've had many clients say to me, they have excellent customer service. And when we do a recording of the phone calls and we track those calls for a month, they're lucky if they hit 50%. And it's very humbling, but it's also low-hanging fruit. And then finally, gross revenue per planned maintenance agreement customers. To calculate this, we take the gross revenue by planned maintenance agreement customer, which includes the planned maintenance agreement, indoor air quality add-ons, equipment upgrades, water heaters, water softeners, fireplaces, any product or service that your company handles. And we divide that revenue by the number of planned maintenance customers. Our target is $835 per planned maintenance agreement customer. Now, going back to my number of 1,200 planned maintenance customers equals $1 million worth of business. It's ironic that if you divided $1 million or multiply 835 times 1,200, you're going to come up with $1 million. This is where the rubber hits the road. This is what can kill a company. I have worked with many companies in the past that have planned maintenance agreements coming out the wazoo. They're proud to tell me they have 2,800 planned maintenance, 3,800, 1,400, whatever that number might be. And I ask them to give me the revenue per planned maintenance agreement customers. And they are shocked to see that their number is $165, $250, maybe $300. The opportunity we know is $835. So what can we do to gather that low-hanging fruit, those extra dollars? Training is the key. And I guess that's kind of where ClimateCare comes in. But so without critical performance measurements in place, we have no measurement of success. We have no measurement of failure, although we feel that our company is not doing as well as it could. We have no targets, no destinations, no roadmap. Imagine again, you're going and playing a round of golf with 3 of your buddies and no one's carrying a scorecard. How much fun would that really be? Without it, we have no cause for celebration when we arrive at a destination. So just imagine, okay, this week, folks, we're going to reduce our AR from 100,000 down to 20,000. We're going to increase our closing rate from 50% to 51%, to 52%, to 53%. These are all things that you can celebrate successes are, and you're going to be climbing the ladder to having a very successful company where you're going to make more money, have more fun, and create a business that's going to be very saleable at the time that you're ready to exit. Final closing comment I'd like to talk to you about is, what is your company's actual net conversion rate? And if you're not going, huh, I would be surprised. If I told you that the average HVAC company, without any training, only collects revenue from about 16 out of every 100 customers that come their way, would that shock you? I can show you why. So join me November the 9th to find out why, when we continue on the 3 rings of success: having more money, having more fun, making more money, and prepare your business for sale to the highest bidder. I hope you've enjoyed this information. I hope you've gotten a pearl out of it, or maybe an aha moment. I'm looking for cards and letters. If there's anything that I can help you with, please reach out to me. Sadia, I'm open for questions, and we'll go from there.
Thank you, Glenn. I'm going to read a couple of questions we have. How do you collect data for call conversion rate?
Okay, very good question. So you can start out with something as simple as a piece of paper with 2 columns. When the phone rings, you put a tick mark on the sheet. When you hang up the phone, you put another tick mark. Did we have an appointment or did we not have an appointment? I don't care about any other information right now. That's your starting point. And at the end of the day, the week, the month, you're going to have someone collect those pieces of paper and add them up. So here's the golden rule. Whoever closes the call is the person that records the call. So in other words, I answer the phone, I book or don't book an appointment, and I say goodbye. I'm going to say one phone call, no appointment. If I answer the phone call and they want to speak to Santa, I'm going to pass the phone to Santa, and Santa is going to record the call. Now, if she closes the call, she's going to record that she received a call and was it closed? Did it turn into an appointment? Did it not turn into an appointment? Start with that first. See what those numbers look like, and then start to refine from there. Was it a service call? Was it a install call? Was it a planned maintenance agreement call? Was it a social call? Social being anything other than starts out with, I'm interested in, my thing is broken. I need to have someone come out and look at this. All of those calls are call opportunities to action. That's what I want to record.
Okay, going back to cash spread, how many months should I have tucked away?
Your accountant, most business coaches are going to ask you to have 3 to 6 months of monies put aside. Now, it's been tough through COVID, and there's going to be months, January, February, March as an example, that may be difficult to even build on your cash spread because it may be costing you money. But if you had 3 months, at least 3 months, anywhere between 3 and 6 months, you can rest very nicely at night knowing that you can be the company that pays its bills.
Who would I contact to find out about getting a tracking sheet?
Okay, well, you can reach out to myself. You could reach out to Victor. There are other coaches out there that can help you with that. But certainly if you wanted to reach out to me, I would be more than happy to point you in that right direction.
Okay, thank you. Last question. Why would I track material percentage per install again?
That's a good question. And it kind of reminded me of something that I glazed over there. Why is it important to know your labor and your materials and your gross margin? Well, one of the biggest things that can happen when you have people working unattended in the field, I liken it to my truck, or I am a service or install technician for your company, and my truck is my store. And so by having that information, I know whether I'm losing, stealing, breakage parts, because my numbers are getting out of control. Same with labor. I have done a significant amount of forensic accounting over the years for clients, and they know something's not right, but they just can't figure it out. And so by tracking this information, we can very quickly find material theft, labor theft, or something as simple as we're not charging for the parts that we're using. So when that number gets out of whack at the end of the year, we have $10,000 worth of parts and $5,000 worth of cost against parts. $5,000 worth of parts would have been missing. So there's a second point to this, and this is where it rolls into tracking closing rates and lead generation. We don't think of a lead or an opportunity to sell something as a inventory item. Let me explain really quickly here. If you bought 10 thermostats and you sold one and there was nothing on the shelf, you would probably go into a tailspin trying to figure out where those thermostats went. Most companies don't control their leads. But if I said to you, you had 10 leads come in, each being worth $7,000 to $9,000, and no one went to 9 of them, that's inventory loss, that's inventory control. These are the reasons why we track closing rates, average ticket prices, gross margin dollars profit, materials, and labor.
Okay. So yeah, that's about it. So that's great. Thank you, Glenn.
You're welcome.
This ends our presentation for today. I hope our members found this informative. If you have any questions, please feel free to reach out to HRAI. Additionally, please complete the evaluation survey that will appear on your screen at the end of the webinar. And with that, have a great afternoon, everyone. And thanks again, Glenn.
You're welcome. And we'll see you guys on November the 9th for 3 Rings of Success. Now we're going to put those first 2 sessions, we're going to wrap it up into one tidy bow.
Perfect. Thanks a lot. Bye, everyone.
Bye now.